In 2015, the average car insurance premium in America was about $1,200 per year. 10 years later, in 2025, that same coverage costs about $2,300 per year. That's nearly double in just one decade. And here's what makes people particularly frustrated. Many drivers are paying double while driving the same car they had in 2015, or even an older, less valuable car with the same clean driving record they've always had. Nothing about your personal situation changed, but your insurance bill doubled anyway. Today, I'm going to walk you through exactly what happened in the car insurance industry between 2015 and 2025 that caused this dramatic spike, where your premium money is actually going, and why being a safe driver with an older car doesn't protect you from these increases. Let's start by looking at exactly how much car insurance costs increased over the past decade and what that means for your wallet. In 2015, the average annual car insurance premium was about $1,200 nationally. This varied by state, age, driving record, and coverage level, but $1,200 was the baseline average. By 2025, that average climbed to about $2,300. That's a 92% increase in 10 years. For context, general inflation during that same period was about 37%. Car insurance went up nearly 2.5 times faster than overall inflation. Let's put this in monthly terms, since that's how most people think about their bills. In 2015, you were paying about $100 per month for car insurance. In 2025, you're paying about $192 per month. That's an extra $92 per month, or about $1,100 more per year, for the same coverage. For a household with 2 cars, that's an extra $2,200 per year in insurance costs compared to 2015. That's money that could have gone to savings, paying off debt, family activities, anything else. The increases weren't uniform across all groups. Young drivers under 25 saw significant jumps. Drivers in certain states, particularly Florida, Louisiana, Nevada, and California, experienced some of the steepest increases. But virtually every category of driver in every state saw substantial rate growth during this decade. What frustrates people most is that the traditional factors that affect your individual rate either stayed the same or actually improved for many drivers. Your car is 10 years older now and worth less. You might be driving less than you did in 2015. You maintained a clean driving record. By traditional insurance logic, your rate should have decreased or at least stayed stable. Instead, it doubled. 5 major changes happened between 2015 and 2025 that fundamentally altered the economics of car insurance. Factor number 1. Cars became computers on wheels. This is the single biggest driver of increased insurance costs. Between 2015 and 2025, the technology in cars changed dramatically. In 2015, a base model sedan might have had a backup camera and maybe Bluetooth. By 2025, even budget cars come loaded with technology. Lane departure warning, blind spot monitoring, automatic emergency braking, adaptive cruise control, forward collision warning, parking sensors, massive touchscreen displays, sophisticated driver assistance systems. These went from luxury car options in 2015 to standard features in most cars by 2025. All of this technology makes cars safer in many ways and prevents some accidents. But when an accident does happen, it makes repairs vastly more expensive. A minor fender bender that might have cost $2,000 to fix in 2015 can now cost $6,000 to $8,000. You're not just replacing a bumper and headlight anymore. You're replacing radar sensors, cameras, ultrasonic parking sensors, computer modules that control these systems, and then paying a technician to recalibrate everything so it works properly. This recalibration requires specialized diagnostic equipment that repair shops had to invest in. Let's look at specific examples. Replacing a side mirror in 2015 might have cost $150 to $200. Today, that same side mirror contains cameras, blind spot sensors, heating elements, motorized adjustment, turn signals, and sometimes additional monitoring systems. Replacing it costs $500 to $1,000. Windshield replacement is another dramatic example. In 2015, a windshield was mostly just glass. Today, windshields often contain sensors for rain detection, cameras for lane-keeping assistance, heads-up display projection areas, and acoustic dampening layers. Replacing a windshield in 2015 cost about $200 to $300. Today, it's $800 to $1,500 because you're paying for the glass, the embedded technology, and the recalibration of all the safety systems that depend on that windshield. Even paint repairs got more expensive. Modern cars use more sophisticated multi-layer paint systems, often with metallic or pearl finishes, that require more steps and more expensive materials to match correctly. Between 2015 and 2025, average repair costs increased by about 50 to 60%. Since insurance companies pay for these repairs when you file a claim, this increase flows directly through to higher premiums. Factor number 2. The pandemic disrupted everything. The COVID-19 pandemic, which started in 2020, created massive disruptions in the automotive industry that affected insurance costs in multiple ways. First, it disrupted parts supply chains. Microchip shortages meant repair shops couldn't get the computer modules, sensors, and electronic components needed to fix modern cars. Cars that would have been repaired in a week in 2019 sat in repair shops for months in 2021 and 2022 waiting for parts. During this waiting period, insurance companies had to pay for rental cars for customers. A repair that would have cost the insurance company $3,000 in parts and labor in 2015 now cost $3,000 for the repair plus $2,000 for 3 months of rental car coverage. Parts prices themselves increased dramatically. When microchips became scarce, their prices spiked. Shipping costs from Asia to the US increased substantially. Repair shops faced higher costs for everything, and these costs got passed to insurance companies through higher repair bills. Labor costs at repair shops also increased significantly. Shops struggled to find and retain qualified technicians, especially technicians trained to work on modern computerized vehicles. Shops raised wages to compete for talent, and those higher labor costs showed up in repair bills. Factor number 3. Used car values went crazy. Between 2020 and 2022, used car values increased by about 40 to 50% in many cases. A car that was worth $12,000 in 2019 suddenly was worth $18,000 to $20,000 in 2021. This happened because new car production slowed dramatically due to chip shortages. People who would have bought new cars couldn't, so they bought used cars instead. Demand for used cars exploded while supply was limited, driving prices up. When your car is totaled in an accident, the insurance company pays you its current market value. When used car values jumped 40 to 50%, insurance companies found themselves paying out much larger settlements for total loss claims. Even though used car prices have come down somewhat from their 2022 peaks, they're still significantly higher than 2015 levels. A 5-year-old sedan that would have been valued at $10,000 in 2015 might be valued at $16,000 to $18,000 in 2025. That $6,000 to $8,000 difference gets paid by insurance companies when cars are totaled. Factor number 4. Driving behavior and claim patterns changed. After the initial pandemic lockdown period when miles driven decreased dramatically, driving returned to near normal levels, but patterns changed in ways that increased insurance claims. Traffic fatalities increased significantly in 2021 and 2022 compared to 2015 levels. Research suggests several factors contributed. More aggressive driving after lockdowns ended, more speeding on roads that were temporarily less crowded, more distracted driving as people spent more time on phones during and after the pandemic. Distracted driving, particularly phone use while driving, became an even bigger problem between 2015 and 2025, despite increased awareness campaigns. The proliferation of apps, social media, and phone-based entertainment created more temptation to look at phones while driving. Vehicle theft rates also increased, particularly for certain makes and models. A social media trend showing how to steal certain Kia and Hyundai models created a theft epidemic for those brands starting in 2021. This resulted in massive claim spikes that affected premiums for all drivers, not just those who owned vulnerable models. Factor number 5. Natural disasters and severe weather increased. The frequency and severity of natural disasters affecting vehicles increased notably between 2015 and 2025. Hurricanes Harvey, Irma 2017, Michael 2018, Laura 2020, Ida 2021, and Ian 2022 and others resulted in hundreds of thousands of vehicle damage or total loss claims each. Severe flooding events across multiple states damaged vehicles even in areas not directly hit by hurricanes. Wildfires in California and western states destroyed thousands of vehicles. Severe hailstorms, which have become more frequent and more severe, damaged hundreds of thousands of vehicles across the Great Plains and Midwest states. Climate patterns shifted in ways that increased the frequency of severe weather events. Insurance companies spread these disaster-related costs across all policyholders nationally, not just those in directly affected areas. This means even if you live somewhere with no hurricanes or wildfires, your premiums still increased partially to cover these catastrophic events. This brings us to the frustrating reality: why being a safe driver with an older car doesn't protect you from rate increases. Car insurance pricing is based on two components. First, there's your individual risk profile, your age, driving record, car type, mileage, credit score in some states. These factors determine where you fall within the rate structure. Second is the baseline cost structure, the overall level of rates needed to cover claim costs industry-wide. What happened between 2015 and 2025 is that the baseline cost structure increased dramatically for everyone. Individual factors still matter. You'll pay less than someone with accidents on their record, but the starting point is much higher than it was in 2015. Think of it like this: insurance is a risk pool. Everyone pays into the pool and the pool pays out claims. The pool needs to collect enough money to pay all the claims plus operating expenses plus a reasonable profit margin. Between 2015 and 2025, the cost of claims increased dramatically. Repairs cost 50 to 60% more, total loss payouts increased due to higher car values, weather-related claims spiked. The pool started paying out much more money. For the pool to stay solvent and able to pay claims, more money needs to come in. That means everyone's contribution, premium, needs to increase, irregardless of whether they personally filed a claim. You might have a perfect driving record and a 10-year-old car worth half what it was worth new, but you're still in the same risk pool as everyone else. When the pool's costs increase, your premium increases too. This is why your specific situation, older car, clean record, lower mileage, doesn't insulate you from the rate increases. The increases reflect system-wide cost pressures that affect all policyholders.
Let's break down where your $2,300 annual premium actually goes. For every dollar you pay in car insurance premiums, approximately 65 to 70 cents goes directly to paying claims. This includes vehicle repairs, total loss payouts, medical payments for injuries, legal costs from lawsuits, everything directly related to covering damages from accidents. Another 20 to 25 cents goes to operational expenses, employee salaries, office costs, technology systems, marketing, agent commissions, regulatory compliance, customer service, all the costs of running an insurance company. The remaining 5 to 10 cents is profit margin. Insurance companies are for-profit businesses, but the profit margin on auto insurance is relatively modest. They make money, but they're not keeping anywhere near half of your premium as profit. When we look at why premiums doubled between 2015 and 2025, the primary driver is that first category: claims costs increased dramatically. If repair costs go up 60% and total loss payouts increase due to higher car values, the company needs significantly more premium revenue just to maintain that 65 to 70 cents per dollar going to claims. Insurance companies are regulated at the state level. They can't just raise rates whenever they want. They have to file rate increase requests with state insurance commissioners and justify those increases with data showing that their claims costs have increased. Different states have different regulatory approaches. Some are more consumer-friendly and scrutinize rate increase requests more carefully. Others approve increases more readily. It's worth noting that during this period, particularly from 2020 to 2023, many insurance companies actually struggled with profitability on their auto insurance lines. Claims costs increased faster than they could adjust their rates, especially in states with slower regulatory approval processes. Several major insurers reported operating losses on auto insurance during this period, even while raising rates. This doesn't mean customers should feel sympathy for insurance companies, but it does help explain why rate increases were so widespread across all companies. It wasn't one company deciding to price gouge, it was the entire industry responding to fundamental increases in the cost of providing coverage. Insurance costs vary dramatically by state, and the rate increases between 2015 and 2025 also varied. Michigan, Louisiana, Florida, and Nevada saw some of the highest rates and steepest increases. These states have various factors that drive up costs: high rates of uninsured drivers, legal environments that encourage lawsuits against insurers, severe weather events, high vehicle theft rates. Florida, for example, has frequent hurricanes, high fraud rates, and a legal environment that makes injury claims expensive. Louisiana has frequent hurricanes and floods. Michigan had unusual insurance laws requiring unlimited personal injury protection coverage, making it extremely expensive until recent reforms. Conversely, states like Maine, Vermont, Idaho, and Iowa tend to have lower rates due to lower accident frequencies, less severe weather, lower population density, and fewer uninsured drivers. These state differences explain why someone in Louisiana might pay $4,000 annually, while someone in Maine with the same car and driving record pays $1,200. Given these industry-wide cost pressures, what can individual drivers do? First, shop around regularly. Different insurers price risk differently and have different expense structures. Getting quotes from multiple companies every year or two can sometimes find you significant savings. An insurer that was cheapest for you in 2015 might not be cheapest in 2025. Second, review your coverage levels and deductibles. If you increased your deductible from $500 to $1,000, you might save 10 to 15% on your premium. If you have an older car that's paid off and not worth much, consider whether you need collision and comprehensive coverage, or if you'd rather self-insure that risk and pocket the premium savings. Third, ask about all available discounts. Insurers offer discounts for bundling auto and home insurance, paying annually instead of monthly, having certain safety features, low annual mileage, good student discounts, safe driver programs, and other factors. Make sure you're getting every discount you qualify for. Fourth, maintain a clean driving record. While good driving doesn't protect you from industry-wide increases, tickets and accidents will make your individual rate significantly worse on top of the baseline increases. Fifth, consider usage-based insurance programs where you install a device or use an app that monitors your driving. If you're genuinely a safe driver with low mileage, these programs can offer substantial discounts, sometimes 15 to 30%. Finally, if you're in a state with particularly high rates, consider contacting your state representatives about insurance reform. While this won't help your immediate rate, regulatory and legal reforms can affect insurance costs over time. Insurance costs doubled from about $1,200 in 2015 to $2,300 in 2025 due to 5 major factors. Modern cars became loaded with expensive technology that costs 50 to 60% more to repair. The pandemic disrupted supply chains and spiked parts costs. Used car values jumped up and stayed elevated, making total loss claims more expensive. Driving behavior changes increased claim frequency and severity, and natural disasters became more frequent, creating massive weather-related claim spikes. These are industry-wide cost pressures that affect all drivers, regardless of individual circumstances. Your clean driving record and older car still matter for your individual rate compared to risky drivers with new, expensive cars. But the baseline everyone starts from increased dramatically because the fundamental cost of insuring vehicles increased. Understanding where these increases came from helps make sense of why your bill doubled, even though nothing about your personal situation changed. If you found this explanation helpful, share it with someone frustrated about their insurance costs. Leave a comment about how much your rates increased over the past decade, and subscribe for more videos breaking down why essential costs have changed so dramatically. I'll see you in the next one.